Hello everyone, welcome to my channel. I am Shoumojati Lahiri, and in this channel I will be teaching or discussing about the chapters in Chartered Accountancy under the Institute of Chartered Accountants of India. Today in this video I am starting with CA Foundation Paper 1, that is Principles and Practices of Accounting, Chapter 1, Theoretical Framework, Unit 1, Meaning and Scope of Accounting. So let's start. First of all, I want to give a disclaimer that this is not an educative video but a video to revise and also to recall the theories in this chapter. This chapter is regarding theory, full theory chapter, and nothing is related to practical knowledge. So these chapters carry very less marks and also very less weightage in the examination. But these chapters are important for basic knowledge and also for minor 2 to 3 marks question that comes in question number 6 or any other part question. So let's start with chapter 1, unit 1, paper 1, accounting. So here we come to know about the procedures of accounting. The procedures of accounting consist of generating financial information and using the financial information. When we are generating the financial information, we need to use it in some place or it will be meaningless, right? Yes, if we are generating the financial information, it consists of recording, classifying and summarizing the transactions or the data. In our childhood, we have learned about data. A data is any information, or from a data we construct an information. What is data? It is unstructured and it is unorganized information that is used to know or to learn about something. So in this case, in accounting case, the data or the transactions or the business transactions which we go on throughout our life or throughout the life of a business is considered as a transaction or it is a financial information. So we need to generate the financial information and then these financial information needs to be reconstructed, restructured and organized for using them in a productive way. So generating the financial information consists of recording, classifying and summarizing. Then we need to use the information, we need to use the financial information. It consists of analyzing the financial information, interpreting the financial information and communicating them. So analyzing means we need to analyze. We are producing an information, we are producing a set of information or set of accounts through the accounting process. We need to analyze whether our expenses are going up, how our income are going up, or whether our incomes are coming down or expenses are increasing or decreasing, whether our profits are increasing or decreasing. We need to learn about that so as to improve the life of the business and also to improve the entire functioning of the business or any business entity or any entity which is profit oriented or not. So let's come to the introduction. This chapter is fully theory based and we need to remember few important topics and not the entire chapter. So in this first portion we are here to introduction. Every individual performs some kind of economic activity. A salaried person gets salary and spends to buy provisions and clothing for children's education, construction of house, etc. A sports club formed by a group of individuals, a business run by an individual or a group of individuals, a local authority like Calcutta Municipal Corporation, Delhi Development Authority, governments either central or state, all are carrying some kind of economic activities. Not necessarily all the economic activities are run for any individual benefit. Such economic activities may create social benefit that is benefit for the public at large. The example of social activity or creating social benefit is through the government. The Indian government or the government of any country works for the social benefit of the citizens. So their expenses or their expenditure are concerned with public demand, public supply, supplying goods to public for their benefit. So anyway, such economic activities are performed through transactions and events. So here we come to the very important introduction where we learn about the transactions and events. This is very important through exam point of view. Transaction. Transaction is used to mean a business, performance of an act, an agreement or an agreement. A transaction is something which involves the taking or giving of money. So, in that case, a transaction is successful when we give a money or give something with monetary terms and receive something having monetary terms or monetary value. Events are a happening as a consequence of transactions, a result. Even through a transaction, we go through a transaction to have an event. We enter into a transaction to become or to perform an event. For example, we sell goods, we give away a good which has a financial or monetary value, we receive money, we receive currency as a money. And what is the event? It there is a hidden event, that is earning of profit. When we sell out goods, we earn profit. Earning of profit is an event, but the selling of the good and receiving money for the sale is an event, is a transaction, not an event. But the profit earned is an event. So here's an example. Let's see. An individual invests rupees 2 lakh for running a stationery business. Okay, very good. Invest rupees 2 lakh. So this is an event because no giving, no taking. It is a situation or an event or a happening. So it is an event. On 1st January, he purchases goods for rupees 1,15,000 and sells for rupees 1,47,000 during the month of January. So here comes transactions into play. He is purchasing the goods and selling them off. He is purchasing, he is giving away money, he is receiving the goods. Again, he is giving out the goods and receiving the money. In this process, he is earning a profit. The difference is rupees 1,15,000 he purchased and he sold the same goods for 1,47,000. So in the between the 15,000, he also has 5,000 as a rent and 15,000 goods in hand. He is selling, he is purchasing rupees 1,15,000. He is having 15,000 goods in his storage or in his godown, and he is selling out for 1,47,000. So what is this? He is earning a profit of 42,000, right? In this case, the earning of profit is an event. The purchasing and selling of the goods are an example of transaction. So from here we can understand the topic of transaction and event. A transaction is a giving and taking of any substance or anything that has monetary value or has a financial weightage. Event is what? Event is an occurring that is a result from a transaction. First, we incur a transaction or a transaction occurs which gives result to an event. A transaction gives result to an event. So here it is related. Transactions and events are related or interrelated. If there is any question, if transaction or event is related, then you can explain that a transaction gives rise to an event, right? So here comes the next topic. If you want to read this topic, this paragraph, you are very welcome. You can read this entire topic, but this is not important for the exam point of view. But here it's an important point. Accounting is the language of business. Accounting is what? Accounting is the recording, classifying, summarizing, analyzing, interpreting, and communicating of the financial information of any business firm. So, this entire accounting is termed as the language of business. So, let's read this paragraph. Thus, to understand accounting as a field of study for universal application, it is best identified while recording of business transactions and communication of financial transaction or information about business enterprise to facilitate decision making. The aim of accounting is to meet the information needs of the rational and sound decision makers. So, what is the aim of accounting? The aim of accounting is to meet the information needs. The aim of accounting is to meet the information needs of the rational and sound decision makers. So, who are the decision makers? Owner or management, a owner or manager of a business. He is a rational decision maker. He needs to make decision which goods to sell, how to sell the goods to earn profit, which goods are incurring loss, how to avoid selling them. So here it comes to the accounting is the language of the business. If accounting was not there, a manager or owner or anyone could not analyze the information or the information about the business. Financial information related to the business could not be analyzed or could not be understood. This is why the accounting is called the language of the business. If you are not able to know about the basics of the business, what are the profits, what are the losses, what are the expenses, what are the incomes, what goods purchased for what money, what is the sale price of a product, how could you analyze the business, or how could you analyze the future of a business or your activities related to the business? So accounting is called the language of the business. Now comes the meaning of accounting. The meaning of accounting, the committee on terminology set up by the American Institute of Certified Public Accountants. As we have Institute of Chartered Accountants of India, in America we have the American Institute of Certified Public Accountants. In India we have CA, and in America we have CPAs. So, the definition formed by American Institute of Certified Public Accountants say that accounting is an art. Accounting is an art of recording, classifying, and summarizing in a significant manner and in terms of money. So, let's repeat. Accounting is an art of recording, classifying, and summarizing in a significant manner and in terms of money the transactions and events which are in part at least of financial character and interpreting the results thereof. So here we come to know that accounting is an art, right? Accounting is an art of recording, classifying, and summarizing in a significant manner. If we have an information or if we have a transaction in our hand and we just write it down, so expenses for rent is 5,000 rupees. This is it's just written down. It's not useful enough, because at the end of the year when the owner or the manager or anyone would see that expense for rent 5,000, it would not make any sense, right? It would not make any sense, because and he will not understand why the expenses, how the expenses were incurred, what is the ratio or which is the proportion in which the expenses is incurred. So the information in accounting needs to be done in a significant manner and in terms of money. It is very obvious, if we are not able to if you are not able to say in terms of money, for example rent 5,000 rupees or $5,000 or 5,000 euro, how can we say it is accounting? Accounting is related to money, right? That is why in terms of money we cannot term an expense such as expense in anything, expense in kg or expense in meters, right? It is mandatory for expressing in money terms, in monetary terms. So accounting is an art of recording, classifying, and summarizing in a significant manner and in terms of money Transactions and events. So it is a point to be noted. Transactions and events both need to be recorded. Transactions and events both need to be recorded in the books of accounts. Both has to have a monetary unit, a monetary term. Both needs to be on a monetary basis. So it is equal for measurement in the accounting records, right? So it should have a financial character. It is given it should have a financial character. So as for this definition, accounting is simply an art of record keeping, right? According to this definition, the accounting is just record keeping, but no, accounting is not just record keeping. It includes analysis, it includes interpretation, it includes communicating the financial information to the users or the person who require the information. So it is not just record keeping, right? The process of accounting starts by first identifying the events and transactions which are of financial character and then be recorded in the books of accounts. So we need to first recognize the transactions. If you would never know which transactions to be recorded, how can you put this information to the books of accounts? Without knowing the transactions which needs to be recorded, if you record everything, each and everything, the books or the place where you are recording the transaction would become meaningless, right? That is why it needs to be identified which are the transactions, which are the events that are in monetary terms and which needs to be recorded. So the recording is done in journal or subsidiary books which are known as primary books. I think you have done already journal or journal entries in class 11. So journal entries are the basic or the base of accounting. In journal, you need to record the transactions. Then, or in journal or subsidiary books, to ease out or to reduce the bulk of the journal book, we prepare subsidiary books such as cash book, petty cash book, purchase book. Examples are pretty much, and I think you have all have done about these in your class 11 and 12, the subsidiary books and journal entries. So journal is the primary book. Without journal, if journal is not there, if journal is the base, if journal is not there, how can you prepare ledger, or how can a ledger result into a trial balance? That is why a journal is mandatory. Every good record keeping system includes suitable classification of transactions and events. We need to classify the transaction and events so as to interpret or to analyze or to tell the users that yes, this is the information, this needs to be analyzed, this is important, right? That is why. So now the function of accounting is to provide quantitative information primarily of financial nature about economic entities that is needed to be useful in making economic decisions. Let's repeat this. The function of accounting. What is the function of accounting? The function of accounting is to provide quantitative information primarily of financial nature about economic entities. Quantitative information, financial nature. Quantitative, it needs to be quantified, it needs to be measurable. You need to measure it, okay? It needs to be measured. In what terms? Monetary terms or financial terms. In financial information, you are not going to record in meters or in kilogram or anything in grams. You need to have a monetary. For example, you are purchasing 5 kilogram of any stock, 5 kilogram of any input for rupees 5,000. The rupees 5,000 is important from accounting point of view, okay? Another thing important is you're purchasing 5 kilogram for rupees 5,000. That is 1 kilogram for rupees 1,000. And that 1 kilogram price of rupees 1,000 needs to be analyzed by the users so as to analyze whether they are purchasing for a higher price, for a lower price, they are incurring more costs or they are incurring less costs. So the next point, thus accounting may be defined as the recording, classifying, summarizing, analyzing, and interpreting the financial information. So, if there is a question, define accounting. Define accounting. So, the define accounting would be answered. The accounting may be defined as the process of recording, classifying, summarizing, analyzing, and interpreting the financial information or financial transactions and communicating the results thereof. You are recording, you are classifying, analyzing, interpreting, summarizing, everything you are doing. You are not communicating. So it's useless, right? It needs to be in the information, that is the processed information, the processed transactions, information transactions should be communicated to the users so that they can take proper decisions using the financial information. So from the above definition, from the above discussion, there are now comes the procedural aspects of accounting. The procedural aspects of accounting consist of generating the financial information, using the financial information. I have already discussed the same thing, generating the financial information and using the financial information. Generating financial information. Recording, the basic function. Recording is the basic function. Without recording, how can you interpret? How can you analyze? How can you even what is it? Accounting is a recording. Accounting is recording, classifying, summarizing. Without recording, how can you classify? How can you summarize? Analyzing is the next step. Analyzing is far away, but how can you classify or summarize? So, recording is the basics function, and recording has to be backed with proper evidence, right? You have a 5,000 rupees invoice. In return of that invoice, in this invoice, information should be given in the financial statement or financial information. Without proper evidence, you cannot put any entry. Means you have not incurred any expense, you have not incurred any rent, but you are writing, I have paid rent of rupees 3,000. So it is misleading, right? It is a fraud. It is a type of fraud or misleading information. So every time it is any information or any financial information is recorded, it needs to be backed by evidence. It needs to be backed by proper and correct evidence. Second, classifying. Classification is concerned with systematic analysis of recorded data. Systematic analysis, the analysis, systematic procedure, it needs to be processed, it needs to be systematized, there needs to be proper steps in classifying. So classification is concerned with systematic analysis of the recorded data with a view to group transactions or entries in a compact and usable form. Now comes summarizing. Summarizing, preparation and presentation of classified data usable to internal and external users. Summarizing, preparation and presentation of the classified data useful to the internal and external users. Analyzing means, or analysis means, methodical classification of the data given in the financial statements. Methodical classification, a proper step, there needs to be proper step or method in classifying the data. For example, the method, if you have recorded an expense but analyzing it as an income, your analysis would be wrong. So there needs to be proper method. The classification needs to be methodical. An expense should be seen or should be understood as an expense, and income should be understood as an income. So accounting is that an expense needs to be understood as an expense, and any income needs to be understood as an income. This is the objective of accounting. Interpreting is explaining the meaning and significance of the relationship as established by analysis of accounting data. Interpreting, we need to explain the meaning, right? Interpreting, we need to interpret. For example, there is a financial statement, there is a financial information. Now we need to interpret it. What is an expense? What is an income? What is the profit? What is the loss? What is the purchasing price of any inventory? What is the selling price of the inventory? What is the storage cost? What is the cost incurred for storing or to keep the goods safe? What is the rent paid for the business area or the area in where the entity is doing the business? What is the rent paid or salary paid to the employees? What are the salaries or wages paid to the employees? We need to interpret it. Last comes the communicating. Communicating is the transmission of summarized, analyzed, and interpreted information to the end users to enable them to make rational decisions. Communicating or accounting is based to be able to take rational decisions. Rational means correct decisions or right decisions. For example, if a business is incurring losses, but the financial information, the financial a business incurring loss, but the financial information is showing a profit, it is misleading. The decision makers would not be able to make proper decisions. So the decisions taken from a misleading financial information should not be rational enough, right? That is why communicating properly the information from the financial statements should be rational and properly communicated. The first two procedural stages of the process of generating financial information, along with the preparation of trial balance, are converted or are covered under bookkeeping. The first two procedural stages of generating and the generating, analyzing, and preparing the trial balance is covered under bookkeeping. The preparation of financial statements and its analysis. Preparation of financial statements and its analysis and interpretation and communication is the accounting stage. So let's see the information over here. So bookkeeping. In bookkeeping, we see the recording. Bookkeeping means the recording through journal. We record the financial information through journal. Classifying through ledger entries. We classify the recorded financial information in journal, in ledger. Then we summarize the information in trial balance. So this consists of bookkeeping. Now comes accounting. Accounting means the analyzing, interpreting, and here it will be communicating. It's missing, I forgot to write it, but accounting and analyzing and interpreting. Accounting means analyzing the information, interpreting the information, and communicating them. So here let me write it. So yes, the accounting is analyzing, interpreting, and communicating the financial information. And bookkeeping is the recording through journal entries, classifying through ledgers, and summarizing in the trial balance. So now comes Now comes the using the financial information. So in earlier times, the proprietor or owner, in the very in 10 to 15 years before, very less, by 10 to 15 years or 50 years back, the proprietor or owner was the only user of the financial information, right? A user would, the proprietor or owner would use the financial information to analyze his business, to interpret his business, to see whether he's incurring losses, whether he's able to earn a profit. So he used to use. But in today's times, in today's generation, in modern times, when we are open, when a business is open to the world, it is exposed to the world, there are many users. There are many users of the accounting. So the users of accounting are investors, employees. Why investors? If any business is incurring loss, whether an investor would invest or not, that decision would depend whether the business in which he is thinking to invest is incurring loss or is gaining a profit. If he is gaining a profit, the business is gaining a profit, he would invest. So he needs to depend on the financial information. Employees employees the employees, if a manager is saying that a company is incurring loss, and so your in the employees wages or employee salaries could not be given, the employees needs to see, the employees needs to refer the financial information. Yes, my company or my firm is unable to earn profits, earn, unable to go through its business process, so I need to forego my salary or forego my wage, right? So my I need to forego my bonuses. That is why an employee needs to use the financial information. Lenders, a person who is lending to a business, right? Any person who is lending to a business must see whether he is giving to a dead business or not. A dead business is what? A business which is incurring losses from a very long time. A business which has not gone into profits for a very long time, is not having any cash in hand. Then how can that business pay off the lender's loan? Right? A lender has to go through the financial information of the business to see that. Then suppliers, the suppliers of goods to the business needs to see the financial information. If he is a creditor, means if the supplier is giving a credit, if a supplier is giving a goods on credit to the business, he needs to see that whether the business is having cash in hand. If he is if he will be able to pay my debt, he will be able to pay for my goods given. Now, customers need to see the financial information to check whether the company on which they are trusting are using proper quality goods, are investing in R&D or research and development, or they are maintaining the quality, they are expending or they are incurring expenses on maintaining the quality, maintaining the cleanliness within the business or not. Then government also need to use the financial information. Why? For taxes, right? Yes. A government sees the business's information, the financial information, to impose the taxes. If the profits earned by a business is less, the taxes given by the government, the taxes or subsidies given by the government, a government, any country's government gives subsidies to businesses that are suffering losses, or the businesses which are beneficial for the public but are unable to make an income. So government gives subsidies. Or if a business is profitable, the business needs to pay taxes. To analyze the taxes given by the business, the government needs to see the financial information that is made by the business owners, which that are prepared by the business owners, from the evidence, the financial information that is backed by proper evidence, right? Yes, that is why it is given. The financial information should be free from biases. If the financial information is biased, if the financial information is biased, it is faulty. For example, I am incurring an expense. The expense I am writing, but I am having a heavy or huge income, I am not showing it in my financial information. The income is not there, but the expense is there. It is reducing my profits, for which the reduced profits are resulting to reduced taxes given. So that is the government would be harmed. The government would be on a would be a deficit of taxes. It would be a deficit of giving proper service to the public. So the financial information should be free from biases. The owners or the management of the enterprise. So, the owners or the management of the enterprise, commonly known as internal users, or the information they are analyzing in internal analytical manner. There are two types of users of the financial statements: internal users and external users. So, who are the internal users? Internal users are the management, the owner, the employees, or the persons who are related or who are involved within the business are the internal owners. The business, for example, the I've given owners, managers, employees. They are the internal users. Who are the external users? The external users are the lenders, creditors, right? Government, the suppliers, customers. These are the external users. So the users of financial information should be internal users as well and external users as well. So they too form the total user group of the financial information of any business. Evolution of accounting as a social science. So this is the important point. The stewardship accounting was the root of financial accounting system. What is stewardship accounting? 50 to 100 years back, the rich or wealthy businessman used to keep a person who used to write down all the incomes, all the expenses of the wealthy person. He used to jot down all the expenses and incomes that would form the financial information of that time, of that wealthy businessman. That person who used to write down the expenses, write down the incomes, was known as the steward. So the financial accounting system is generated or evolved from that stewardship accounting. So this stewardship accounting is very important. The stewardship accounting has given rise to the financial accounting system of today's date. And rest this paragraph is not so important. You can read it for your reference, and it's not important for exam point of view. But that point is very important, that financial accounting system is from the stewardship accounting. Now comes the objective of accounting. The objective of accounting are systematic recording of transactions. The transactions need to be systematically recorded. Basic objective of accounting is to systematically record the financial aspects of business transactions. That is bookkeeping, the systematically record. This is the important keyword, systematically record, because the information which would not be recorded systematically would mislead or would not be able to be usable to the proper extent. That is why it needs to be systematically recorded. For example, the example of systematically record is the recording of transactions in a chronological manner, which means the expenses which are for 1st January would be recorded on 1st January. After that, the recorder or the bookkeeper will record the expenses or incomes or any transaction that is incurred on 2nd January, then 3rd January. It is chronological. It is a system is followed. That is the systematic recording of transactions. These recorded transactions are later on classified and summarized logically. The classified and summarized logically for preparation of financial statements and for their analysis and interpretation. Number 2, ascertainment of results of above recorded transactions. The recorded transactions or monetary events should be ascertained or should be analyzed to give a result. So the result should be ascertained from the above recorded transactions. So let's come to this point. Accountant prepares profit and loss account, right? An accountant prepares profit and loss account, which you must have created in class 11 and 12, to know the results of business operations for a particular period of time. If revenue exceed expenses, then it is said that business is running profitably. Very obvious. If the revenue or income revenue, what is revenue? Revenue is the amount you are receiving by selling something. If you are selling one item, you are receiving 10 rupees. 10 rupees is the revenue. And if that revenue is less than the costs, less than the expenses, for example, your expense is 2 rupees, but your revenue, the revenue from selling that good is 10 rupees, it naturally you are earning profits, right? Yes. So that profit is the result. That profit which you have earned is the result. Ascertainment of financial position of the business. Businessman is not only interested in knowing the results of the business in terms of profit and loss for a particular period, but is also anxious to know what he owes, what is his liability, what he owes. He needs A businessman should learn about his liabilities to the outsiders and what he owns, that is the assets. For example, a person who is doing a business has a land, it is his asset. He needs to keep record, he needs to keep track of that land, he needs to keep the record for his building which he is owning. Otherwise he might means he will get demotivated, right? Why am I doing the business? I am not having anything, I am not having any asset, I am not having anything that could back me up in my tough times. So why am I doing the business? To support that, the in businessman or the business who is doing the business should know about his assets and liabilities. Liabilities need to be paid at any point of time. The liabilities need to be paid. That is why the liabilities should be known. Otherwise, how can he pay? If he does not pay the liability, his goodwill will go down. He will be accused of fraud. He will be accused of not paying the debts. So his well-being or good his good reputation would go down, or he will have a bad reputation. So the businessman should know about his assets and liabilities. Number 4, providing information to the users for rational decision making. So an important topic which is already discussed in the previous, rational decision making. Rational decision making is very important. Yes, the businessman needs to have a rational decision making. Otherwise, if he is not rational in decision making, if he cannot take proper decisions, the business would be misled. That is why rational decision making is very important. To know the solvency position. So this is important. Solvency position. What is the solvency position? Solvency position. So what is solvency position? Now let's read this paragraph or this marked portion. Ability to meet its liabilities. It means business. It means the business, right? Yes. Ability to meet its liabilities in the short run. This is known as liquidity position. The ability to meet the ability to meet the liabilities is known as liquidity position, and ability to meet the liabilities in the long run is known as solvency. The ability of a business to to meet its liabilities, to pay off its liabilities in the long run is known as solvency position. So the ability to meet a business's liabilities in the short run is known as liquidity position, and the ability to meet its liabilities in the long run is known as solvency position. So the objectives of the accounting. The objective of the accounting are summarized here. Systematic recording of transactions. The systematic of recording of transactions is done through bookkeeping, journal, ledger, and trial balance. Then the ascertainment of results. Ascertainment of results are through manufacturing account, trading account, profit and loss account. Then comes the ascertainment of financial position. First, systematic recording of transactions, then ascertaining the results, then ascertainment of financial position. The ascertainment of financial position is done through balance sheet. Last comes the communicating information to various users. The informations which are collected through accounting, through recording, summarizing, analyzing, interpreting the financial information, it needs to be communicated. The communication is done through financial reports. For example, I'm for a very basic example. If you invest in stock market, many of us invest in stock market. If we go to a company's details, we can see the financial reports. The financial reports of that company says about its profits, its losses, its liabilities, its assets, its various information which is related to the company and is having a financial value. So these are the financial reports. The communication of the information that is prepared through accounting is done through financial reports. Now comes the functioning of accounting, the functions of accounting. What are the functions of accounting? The functions of accounting are measurement. Accounting measures past performance, right? The accounting measures past performance of the business and depicts its current financial position. Accounting measures past performance and depicts the current financial position. For example, if a business has incurred loss in the previous year but is having profits in the books in its current year, that means the financial position of the business is better than last year. So this is measurement function of the accounting. Forecasting. Accounting helps in forecasting future performance and financial position of the enterprise using past data and analyzing trends. If you hear the discussion of any trend analyst, any analyst who invests in the stock market through charts, through analyzing the charts, so what he is doing, he is forecasting his moves. He is forecasting the moves of the stock market through the charts. The charts are the previous data, right? The previous data in the form of charts are analyzed to predict or to forecast the future events in the stock market. That same thing is applicable to the business. The past data of the business are analyzed to forecast the future details, the future of the business. Now comes decision making. Accounting provides relevant information to the users of accounts to aid rational decision making. Decision making is the key to the business, right? And accounting is done for proper decision making. The internal users, the managers, the owners, the managers of the business are dependent on accounting solely for decision making. Now, comparison and evaluation. A business should also compare its information, right? A business should also compare its results with the results of other firms or its results with the previous year. So comparison and evaluation is must. Then control. Accounting identifies weaknesses. Accounting identifies weaknesses of operational system and provides feedback regarding the effectiveness and measures adopted to check such weaknesses. So accounting is also very important for control. Now comes government regulations and taxation. Government has imposed 30% tax rate on companies. I'm giving an example, right? Yes, the financial information would disclose the profits earned by the business, on which on that profit government would calculate taxes. So this is a very important function of the accounting, calculation of taxation and government regulation. The government is regulating the taxation policy, that amount of tax to be paid by the government, by the business, through the business's financial information. Now comes bookkeeping. Bookkeeping is the recording of financial data in significant and orderly manner. Bookkeeping is recording of financial data in significant and orderly manner. For example, a transaction purchasing of goods for 5,000. It is recorded in the books. Purchase of goods rupees 5,000. This is bookkeeping. Maintaining of the books of accounts. Maintaining the books of accounts, recording the data. It is known as bookkeeping. Bookkeeping also requires suitable classification of transactions and events. The transactions and events should be classified. For example, transactions are what? Purchasing of goods. Events are what? Earning of profits through sale of goods. Selling the goods is a transaction, but earning the profit or retaining the profit is an event, right? Yes. Now comes the objective of bookkeeping. Objective of bookkeeping is complete recording of transactions. If the transactions are not recorded properly, will the accounting be accurate? So the objective of bookkeeping is complete recording of transactions. The complete recording of transactions is very important. The complete, this is the main keyword, complete recording. Then ascertainment of financial effect. The financial effect on the business of any transaction should be measured. It is concerned with combined effect of all the transactions made during the accounting period. For example, the bookkeeping is done throughout the year. Then it gives rise to a profit or loss. So a certain amount of financial effect. The financial effect of the business is the profit or loss at the year end, but it is a product, or it is identified from bookkeeping. So the identifying the financial effect of the business is an important objective of bookkeeping itself. Now, distinction between bookkeeping and accounting. This is very important. You need to memorize, or you need to remember 5 steps, any of the 6, but 5 mostly important are 5 points. It comes for 2 to 3 marks in question number 6. Bookkeeping. It is a process concerned with recording. You need to remember these keywords. You need to remember only these keywords, right? Yes. Bookkeeping is concerned with recording. Accounting is concerned with summarizing. Recording, bookkeeping, summarizing, accounting. Then bookkeeping constitutes as base. The bookkeeping, without bookkeeping, how would you do accounting? So the bookkeeping is the base, right? You will record the transactions, you will manage the ledgers, you will form the trial balance, then you can do the accounting. As per this, you need to record, means you need to journalize first. First you need to journalize, then you need to draw up the ledger, then you need to draw up the trial balance, then only after trial balance you can go to accounting, right? Without trial balance, without forming the trial balance, how can you form the accounting? So trial balance, up to trial balance, it is bookkeeping. So this bookkeeping is very important. After this bookkeeping is done, the accounting is accounting. We can proceed to accounting. So, mm, in bookkeeping, managerial decisions cannot be taken through bookkeeping. For example, you have written that expenses 5,000 rupees. Will that writing be important for the managers, or the managers will depend on accounting, means the expense of 5,000 rupees, which is more than past year by rupees 2,000, right? That is important for managerial decision making, means how much there is an increase in expense, how much that expense of 5,000 is affecting the profit of the business. It is important for managers. That is why bookkeeping cannot be the managerial decisions cannot be taken through bookkeeping. In accounting, management take decisions on the basis of accounting records. Bookkeeping has no subfield, but accounting has several subfields. Yes, bookkeeping in bookkeeping is bookkeeping itself. It has no subfields. But accounting is having various subfields. There can be many types of accounting, many subfields, or yes, many types of accounting. So here is an example of the subfield of accounting. So accounting gives rights to, there are human resource accounting, accounting for the human resource, the number of people working in a company, human resource accounting. Financial accounting comprises the profits and losses, the incomes, the expenses. These are the financial accounting, comes under financial accounting. Management accounting. Management accounting is the accounting for the feasibility or the productivity of the management. The management of a firm needs to be analyzed. The working of the management, the expenses on the management or by the management should be calculated under this management accounting. Then cost accounting. Cost accounting is related to maintaining the cost, the recording or accounting for the costs. Costs are the cost for inputs, cost of raw materials, cost of primary goods which are converted to final goods or finished goods by the business. It needs to be, or the costs for employees, costs for wages. These are recorded under this cost accounting. Then forensic accounting. Forensic accounting is related to analyzing or for analyzing the business or analyzing the things related to the business, or it is for investigation purpose. For forensic accounting is primarily related to investigation purpose. Then governmental accounting. What is governmental accounting? The governmental expenditure, the incomes or the transactions for subsidies, the taxes paid. These are governmental accounting. Then comes the social responsibility accounting. This is also a part of this accounting. It is a subpart, a subfield of accounting. Social responsibility accounting. Any company any company which is earning profits or not earning profits but working within the economy has some social responsibility. It has a responsibility towards towards the society or the people in the society. For example, Reliance Industries in India has some responsibility for the citizens of India. That is social responsibility. These type of responsibilities, the expenses for these type of social responsibilities are accounted under social responsibility accounting. So for in this example, we were able to see that in accounting there are various types of accounting. There are 5 to 6 or 7 types of accounting, but in bookkeeping there are no subfields of bookkeeping. Bookkeeping financial position of the business cannot be ascertained. Income of rupees 2000, whether it will be able to give the position of the business or financial effect on the business. The financial effect is rupees 2000 income, therefore the income is 2000 rupees 2000 income, but the financial position of the business can be ascertained? No. But through accounting, financial position of the business can be ascertained. The financial position of the business can be ascertained through the accounting, because accounting is what? Accounting is this analyzing, interpreting and communicating of financial information. That is why through interpreting, analyzing and communicating, the financial position of the business can be can be ascertained. So from this above discussion, it is very evident that bookkeeping is the base, right? Then comes accounting. From bookkeeping, accounting is born. If bookkeeping was not there, accounting was worthless, right? Yes. From accounting, bookkeeping plus accounting forms accountancy, right? Bookkeeping plus accounting gives rise to accountancy as a whole. But bookkeeping is the base, then comes accounting, it forms an accountancy. So, if somebody asks, is accountancy equal to accounting plus bookkeeping? The answer is yes. Bookkeeping plus accounting equals to accountancy. Without bookkeeping, accounting cannot be there. But without accounting, bookkeeping can be there. Because bookkeeping is the recording of the transactions. But accounting needs the bookkeeping, because without bookkeeping, without recording the transactions, how can one interpret or analyze the information, right? That is why without bookkeeping, accounting cannot be present. But without accounting, bookkeeping has its value or has its existence. Now comes the subfield of accounting. We have already seen the subfields of accounting. Here we come the financial accounting. It covers the preparation and interpretation of financial statements and communication to the users of the accounts. Management accounting. Management accounting is concerned with internal reporting to the managers of the business unit. For example, the internal reporting means the business is incurring losses of 3000. These losses are reported internally to the managers, so that the managers can take proper steps so that the losses can be minimized. The company or the firm is able to earn profits, it needs to recover the losses. So this is management accounting. Cost accounting. Cost accounting the terminology of cost accounting published by the Institute of Cost and Management Accountants of India, or it was published by Cost Institute of Cost and Management Accountants of England, defines cost accounting as. So this is important. The definition of cost accounting defines cost accounting as the process of accounting for costs, which begins with recording of income and expenditure of the basis on which they are calculated, and ends with the preparation of periodical statements and reports for ascertaining and controlling costs. So cost accounting results to ascertaining and controlling of costs, right? Yes. The costs incurred by a firm should be ascertained and controlled. So this is the purpose of cost accounting, and cost accounting is a subfield of accounting. Social responsibility accounting. The demand for social responsibility accounting stems from increasing social awareness about the undesirable byproducts of the economic activities. As already discussed earlier, social responsibility accounting is concerned with accounting for social costs incurred by the enterprise and the social benefits created. For example, Reliance is the Reliance Industries Limited is manufacturing petrol from petroleum. The manufacturing of petrol from petroleum is is giving rise, or the environment is being harmed, or the environment is facing problems for the harmful gases which are released from the preparation of petrol from petroleum. So it is a social cost. The social cost which is incurred by the public or by the entire world for Reliance Industries Limited, and the social benefits given by Reliance Industries Limited in return or in compensation for the social cost is needs to be recorded in social responsibility accounting. Now comes human resource accounting. Human resource accounting means human resource attempts to identify, quantify and report investments made in human resource of an organization. In identify, quantify and report investments made on human resources. This means investments for keeping an employee, investments in an employee's training, in recruiting people. These needs to be accounted under human resource accounting. Now comes the users of accounting information. We have already discussed in detail. Investors provide risk capital to business. Investors provide risk capital to the business. They risk their capital because they invest. If the business is not profitable enough, will the investors invest their money? Will they risk their money? No. That is why the investors are a very important user of accounting information. So what type of these investors are what type of users, internal or external? These investors are what type of users, internal or external? Yes, they are external users of accounting or the accounting records. Now comes the employees. We have already discussed employees. Growth of the employees is directly related to growth of the organization, and therefore they are interested to know the stability, continuity and growth. If the company is not going to continue, if the company is not stable, will the employees stay with the company, or they will go to another company for their security, for their job security? So the employees, who are the employees? These are the internal users. The employees are the internal users of accounting. Now in this case it's written leaders, but change it to lenders. Please change it to lenders. Lenders interested to know whether their loan principal and interest will be paid back. Why a lender lends money? He lends money to earn an interest and also receive back his principal money. A lender lends money to a business or anyone to get his principal money back, accompanied by interest. If the lender is not seeing any chance of receiving his money back or getting the interest, will the lender give the business any money? So this needs to be the position of the business needs to be given by or needs to be seen by the lenders through the financial statements. So lenders are the external users of financial statements. Now comes suppliers and creditors. Suppliers and creditors are external users because they are indirectly related to the business. They are not interested in the business, right? They are not interested in the functioning of the business. They are interested in their own profits, their own. If they give a credit to the company, will they be able to recover the same back? That is their main reason or main motive behind studying the financial information. Customers. Customers are also concerned with the stability and profitability of the enterprise. For example, a small business is purchasing its raw material from another business. If this small company sees that their supplier or their supplier, yes, of which this business is a customer, is incurring losses, this can get down, this business can stop. This business needs to find another supplier from whom this business can acquire raw material. So this small business should learn about the financial statements or financial information of this entity so that he can ensure this small business's continuity. If the small business would not see the information of this business, of whom he is a customer, he would lose out of premium supplier or primary supplier, which would lead to business fault or business failure of this small company, of whom they which is a customer of another company, of whose financial reports are being studied by him. Now public. Why public? The public reads the financial information. The public in refers to the financial information of various companies or various business firms to decide whether to invest or not. So whether to invest in the company or not. So the public is an external user. We all know that, right? Now comes management. Management as a whole is interested in the accounts. The management is an internal user, right? Yes, the management is an internal user, and the management is interested in functioning of the business. The management is responsible for the functioning, and also they are interested in knowing about the business, how the business is performing, how the business has done throughout the year. So management is an internal user. Now, relationship of accounting with other disciplines. Accounting and economics. Economics is a science of rational decision making about use of scarce resources. So, the main motive of accounting is to decision making, is to make decisions, rational decisions. So, accounting and economics are related, right? Accounting and statistics. Decision making purposes such precision is not necessary, and hence the statistical approximation are sought. Statistics is related to measuring. Statistics is related to measuring the financial information or financial position of the company or a business firm. Statistics measures or statistics compares. Mainly statistics compares, and accounting is done for comparing the financial information or financial reports of this year, of the current year, with past year or with other businesses. So accounting and statistics are interrelated. Accounting and mathematics. Double entry bookkeeping can be converted into algebraic form. We all know there is a very simple formula which is taken into account for accounting, that is assets equals to liabilities plus capital, right? We have done this in our childhood. Assets equals to liabilities plus capital. So what is this? This is an algebra, right? Assets equals to liabilities plus capital. This is an algebra. Algebra comes under mathematics. That is why accounting and mathematics is totally interrelated. Accounting and law. An economic entity operates within a legal environment. Any legal entity operates any economic entity, any business firm, any company operates within a legal environment. Our country or any country is a legal environment. It is governed by laws, right? Many laws are there. Contract Act, Negotiable Instruments Act, Sales of Goods Act, the Information Technology Act. There are various types of acts. All these acts govern the country, govern the economy. That is why the economic activity operates within a legal environment. That is why it needs to the accountant, the accounting needs to be concerned with the laws relevant, the laws that are prevalent for the economy. Accounting and management. Management is responsible for decision making about the firm. The management is dependent for decision making of the firm. That is why accounting and management is interrelated. Now comes the limitations of accounting. Income statement. There is a misconception. There is a misconception among the public. Income statement shows correct income or loss. A balance sheet depicts perfectly true and fair picture of the financial standing. But think about the moment when the financial information or financial statements are prepared from faulty evidences or faulty invoices, or the main incomes are or the heavy incomes are not regarded for calculations of the financial position. What would happen? The balance sheet would not be true. The financial statements, the income statement would not give a true and fair view. So there comes the limitation. Yeah, I've marked these 3 points. These 3 points are the most important. Accounting ignores changes in some money factors like inflation. We all know accounting is related to historic costs, right? Yes. So inflation is ignored. Accounting, if I buy a machinery for rupees 5 lakh in 2015, that 5 lakh rupees in 2020 would have become rupees 7 lakh 50,000 rupees, for example, taking an arbitrary amount. So that increase in the amount from 5 lakh to rupees 7 lakh 50 is not given any importance. The depreciation in 2020 or 2022 is calculated on the 5 lakh or 5 lakh rupees or the historic cost. That is why accounting ignores changes in some monetary factors like inflation. Now comes financial and the sixth topic. It's very important. Financial statements consider those assets which can be expressed in monetary terms. For example, as it's given in your study material, the financial statements only discuss or only consider the assets which are easily expressible in monetary terms. But a good manager, right? A good manager, a very efficient manager could be of great value for a business entity. If that manager leaves the firm, leaves the business would go into losses. He is a very important asset for the company, but he has no monetary value. He has no value backed by finances. That is why, and that is why the human resource or the manager is not recorded in the books of accounts. If the manager leaves the company, the financial statements would show the company is incurring losses. But why? That would be not shown in the financial statements. And that is why financial statements consider those assets which are expressed in monetary terms. So it can be said that the language of accounting has certain in the practical limitations. The language of accounting has some certain practical limitations. Role of accountant in the society. Role of accountant is need based services. An accountant or a person who has knowledge of accounts or knowledge of accounting of a business entity can give need based multiple need based services, right? Here multiple need based services. For example, an accountant or a person who is having knowledge of accounting can give you financial services, can be your bookkeeper to record the transactions, can be your financial analyst, can be your banker. So any person or any accountant can have multiple need based services. So areas of services of an account: maintenance of books of accounts. An accountant can easily maintain the books of accounts as per the laws or as per the laws stated, or as per the rules and regulations to be recording to record the accounts, to record the books of accounts. Then statutory audit. Every limited company is required to appoint a chartered accountant or a firm of chartered accountants for statutory audit. Statutorily required to report each year. Any limited company, any public company is required to do a statutory audit. What is a statutory audit? Statutory audit is given or is mentioned or is important under the Companies Act 2013, where it says every public company needs to have a auditor in a particular year to audit the books, to check the books of the financial statements, whether they are free from material, whether they are free from errors, or whether and express the true and fair view of the business. So an accountant, a person who is having proper knowledge of accounting, can act as a statutory auditor. Internal audit: a person having proper knowledge about accounting can also become the internal auditor of the company, of any business firm. An internal auditor checks the internal functioning of the business before a statutory auditor checks it. So internal auditor can report on various problems or various setbacks which the business is facing. Taxation: the taxation imposed by the government is looked upon by the accountants, right? What amounts of taxes to be paid, what is the profit amount, on what percentage of taxation has to be paid, what are the provisions for taxation which needs to be followed. Now management accounting. Under management accounting, the person having knowledge of accounts can give management accounting, can be involved with management accounting, means he can give managerial decisions. What are the goods that are resulting to losses, whether those goods should be invested on, which are the customers who are regularly not paying their debts, so whether those customers should be catered. Now the consultancy services. Consultancy services are the services which are given, for example, what are the giving consulting, or consulting the business firm regarding the investments, the regarding expansion of the business, regarding the taking up a project or not, whether a company or a business firm should take up a project or not. These are the consultancy services. Now comes financial advice. Financial advice on investments, whether a company should invest on a particular scheme, whether the company should insure its products or services, whether or insure its employees, whether it needs to take up an insurance plan, whether a company needs to expand its business. For example, if a business expansion, whether a business or an entity needs to take up a business expansion. Investigation: an accountant or person possessing knowledge of accounting can also help in investigation. For example, ascertaining the financial position of the business, whether it is cheaper to manufacture a product or to buy it out. For example, using the theory of outsourcing, right? Yes, if a business would be profitable in outsourcing a product or outsourcing a service, or to manufacture a service within the firm, which would be profitable, it needs to investigate the profit. The accountant can investigate that matter to ascertain why profits have fallen, achieve greater efficiency. How can a business achieve greater efficiency? That can be assessed by the accountant. Whether fraud has occurred, an accountant is easily able to understand whether fraud has occurred by referring the financial information of the entity, right? Yes. Another one is pension scheme. What pension schemes are to be given, how the calculations need to be done, what are the statutes or what are the laws set by the government. So, and other services are this: secretarial work, share registration work, company formation. These are the other works which can be done by an accountant, or especially a chartered accountant, right? Yes, a chartered accountant in industry. So you can go through this topic, and this is not so important, but you can learn about this to understand the working of a chartered accountant within an industry. A chartered accountant is important for statutory audit, to know about the industry, to inform about the finances of the industry, the financial position of the industry. So yes, now we come to the end of the chapter. Thank you for thank you for joining, and thank you for coming to this stage in this video. And so yes, chapter 1, unit 1 of paper 1, accounting principles and practices of accounting, ends over here. Thank you.